Hello everybody and welcome to this lecture on Chapter 18, which is on cost behavior and cost, volume, profit analysis. So in this video, I'm going to explain to you what I mean by cost behavior and what CVP analysis is and what those three elements mean, cost, volume, and profit, and how this tool is useful for managers. So first of all, let's talk about what CVP stands for. Cost, volume, profit. So cost, we've heard that term before in this class, and we've heard it mostly in relation to the cost to produce a product, so your inventory costs. But in this chapter, think of it as just all expenses of the business. Okay, so again, expenses, as we learned in 1A, are goods and services used up in the process of operating your business or generating revenue. So your costs are going to include all of those expenses that go into running your business. Okay. The next element is volume. And again, we've heard that term before in this class, but volume refers to the number of units or quantity. So number of units that you're producing or number of units that you're selling. That's what volume means. It does not mean the sound on your speakers. It does not mean how big your hair is. It is the number of units that you're making or selling. Okay? And then the third element is profit. And profit is another word for income. And as you've learned already in this class, the formula for income is revenue minus expenses equals net income, which again is also called profit, also called earnings, also called making money. Okay, so the way I look at it is costs are the expenses that go into running your business, and profit is what comes out, right? Revenue is when you sell your product, what you sell it for. Expenses are everything you used up in order to be able to sell that product. And what's left or what comes out of it is your profit. So that's why I've got the arrow coming in for cost and the arrow going out for profit. So before we get into more of the calculations, which by the way, we're not really going to get into any calculations in this video. We'll be doing that in class. But I want you to understand the purpose of CVP analysis and all of these calculations. Because as I've mentioned before, this is not a math class. We're not just doing these equations for the heck of it. We're doing them because they have a very specific business purpose and they're very helpful for managers. And how they're helpful is in planning. Okay, because cost and volume, there's a lot of variables going on there. Costs, all kinds of things. We've talked about many different types of costs that a business has, and those can go up and down, and all different things can happen. And volume also is going to go up or down. How many units you're producing or selling is going to go up or down. So managers need that information to predict or to plan what their income is going to look like as all of those variables change. So that's the purpose of CVP analysis, is to predict what your income is going to be if there are changes in your costs or in your volume. So let me give you some examples of those changes, or of the types of questions that can be answered, okay? So it can answer a question such as, what will happen to income if my costs go up? Okay, how is that going to impact how much money I ultimately make? And that could be any type of cost. It could be, say minimum wage goes up. Well, that's a cost going up. Or it could be some of your materials. Like if you use, something like cotton and cotton prices, that's a commodity. It can go up or down. So how is that going to impact my income or the money that I make? Another question is, what will happen to income if I reduce selling prices to increase sales volume? So there you have two variables, right? You're saying, look, I have a product here. It's not selling very well. I think maybe I've priced it too high so my customers can't afford it. So what's going to happen then if I lower my prices a little bit? But hopefully that lowering of prices is going to help me sell more or increase my sales volume. So you've got two variables. You've got prices going down and you've got volume hopefully going up. So how is that going to impact my income? Another question is, what will happen to income if I install a new machine to reduce labor costs? So as we all know, people are expensive, right? You have to pay people to do stuff. And sometimes, they're human, they make mistakes, or maybe they're slow or they get sick. Well, machines kind of counteract a lot of that stuff. A machine can operate a lot faster than a human can, and usually with less error. So sometimes companies will take a process and try to automate that process. Say, look, I'd rather buy one machine that can do the same work that 10 people can do. So here you have two variables changing, but they're both cost. So you have the cost of a new machine going up, but the cost of your labor going down. So how are the changes in those two costs going to impact my income? And the planning can go the other way. Managers can set a desired income or a target income that they want to hit, and then ask, how much do I have to sell in order to make the amount of income that I want? So this is a useful tool for managers in many different ways. And in the process of this class, in this chapter, we're going to be seeing how CVP can help us answer all of these important business questions. But before we can actually do that, we need to make sure we have a good handle on some terminology. And that terminology has to do with cost behavior. And what I mean by cost behavior is that different types of costs behave differently when volume changes. So not all types of costs behave the same. So we categorize costs based on their behavior. And there are two main categories, fixed costs and variable costs. And to illustrate each of these types of costs, I'm going to use an example of Amazon Prime Video. Now, maybe some of you have this, but if you don't, by the way, I think you get free Amazon Prime membership as a student, so you have access to this for free, I think, as a student. But once you get to a point where you're not a student and you have to pay, this is how Amazon Prime Video works. You have a monthly membership, which is about $10, and again, I'm just using this number to keep it simple. It's not exact, but it's close enough. Simple math, but let's say monthly membership is $10, and that gives you access to many different videos. And we're going to call these included videos because they're included in your monthly membership. But those included videos don't include all videos that exist. It doesn't include like the latest releases, or it doesn't include Disney movies, as I know very well because of my kids. Disney does not allow Prime to let you watch their videos for free. So these are what we call rent or buy videos. And those are additional videos that you can rent or buy. Now, you have the option, of course, and there's different prices for each one, whether you rent or buy in different videos. But again, for this example, I'm just going to keep it simple and say that all additional rent or buy videos will cost $15 each. Okay? So let's see how these two different costs behave as volume changes. So first we're going to look at the monthly membership, and I want to explain these graphs real quickly. The way that the graphs work, there's two graphs for each type of cost. Okay, the first graph is going to look at total cost. So the total monthly membership for the month is on the vertical axis, and on the horizontal axis is the volume, or the number of videos watched, right? Because volume has to do with quantity. So what happens to our cost as we watch more videos? The second graph is very similar. It's still number of videos watched, or volume, on the horizontal axis, but on the vertical axis, we're going to look at the cost per video. Okay, how much will it cost us per video as we watch more videos? So let's see this in action. So our total cost for monthly membership is $10. And let's see what happens as we watch more videos. Well, if we watch no videos at all, it's still going to cost us $10. Okay, we committed to that monthly membership fee. If we watch one video, our monthly membership fee is $10. If we watch 5 videos, our monthly membership cost is still $10. If we watch 10 videos, it's still $10. If we watch 100 videos, it's still $10. So that's what happens to your total fixed cost. So the way a fixed cost behaves is in total, it remains constant even as your volume or activity increases. Okay? And that's why we call it a fixed cost, because in total, the cost stays fixed, even when activity increases. But on a per unit basis, so on a per video, let's see how the per video cost changes as our volume changes. So if we watch only one video, that one video is essentially costing us $10. But if we watch 2 videos, now each video is costing us $5 because we're taking that $10 membership and splitting it over 2 videos. And if we watch 10 videos, now each video is only costing us $1 because we're taking that $10 membership and spreading it out over 10 videos. So what happens on a per unit basis for fixed costs is that it goes down or declines as volume increases because you're spreading that cost out over more units. Okay. Variable costs, on the other hand, we're going to look now at the rent or buy videos because these qualify as variable costs. And again, our graphs are the same, but this one is going to be your total rent or buy bill for whatever videos you buy. And then this graph over here is, again, cost per video. So with the variable cost, our total bill, let's see what happens to our total bill as we buy more videos. So if we buy one video and that video is $15, our bill is going to be $15. But if we buy 2 videos, now our bill is $30. And if we buy 3 videos, now our bill is $45. So your total variable costs increase as activity increases. But on a per unit basis, your cost per video stays the same as you buy more videos, right? If I buy one video, each video costs me $15. If I buy 2 videos, each video still costs me $15. If I watch 3 videos, each video still costs me $15. So on a per unit basis, variable costs stay the same per unit as volume increases. Okay? So as a summary of behavior, as volume increases, meaning as we watch more videos or produce more product, your variable costs per unit will stay the same, but in total will increase. Your bill gets higher the more videos you buy. Fixed costs, on the other hand, with a monthly membership fee, it stays the same no matter how many videos you watch, but then each video cost decreases because you're spreading that cost out over more videos. So some examples of each of these types of costs in the manufacturing or a company environment are going to be things like, for variable costs, or things like direct materials, right? The more product you make, the more materials you need. Direct labor. The more product you make, the more labor you need. Sales commissions. The more your salespeople sell, the more you have to pay them. Okay? On the other hand, are fixed costs. And those, again, stay the same even if volume increases. So those are things like rent. Okay, your landlord charges you the same amount whether you make 500 units or 5,000 units. Depreciation on your machinery, assuming it's the straight line basis, that stays the same. It has nothing to do with how much you make. It's going to be the same no matter what. Supervisor salaries. Okay, no matter if you make more or less, that's kind of how a salary works. You say this is how much you get paid on an annual or monthly basis, and that doesn't change. Now, all of these assumptions assume, of course, that we're operating in the relevant range, and that really means normal operations. Does not include any extremely low or extremely high operations. So, for example, if you have a huge sales order and it causes you to have to buy a new machine or hire a bunch more people, now you're no longer in the relevant range and your cost structure is going to change. So, all of these we're going to assume we're in normal operations, nothing out of the ordinary that's going to cause your cost to behave massively differently. So in the next video, I'm going to talk more about CVP analysis.